My presentation is going to be on the secondary mortgage market. So what is a secondary mortgage market? A secondary mortgage market is basically when home loans and serving rights are all bundled together and sold to investors. So if you look at the picture below, the primary market is where the home buyers borrow from the banks and the banks lend the money to issue the loans. And then the secondary market is, so there's a couple businesses called Fannie Mae and Freddie Mac, and they buy the loans from the banks and they issue MBS, which stands for mortgage-backed securities. And then GSE stands for government sponsored enterprise. And they sell these MBS to the investors, to different investors such as pension funds or other types of investors. And the lenders, they can sell the loans to the government spending enterprise, or they can keep the loans for their portfolios for themselves as well. The current situation. So right now, the secondary mortgage market makes it easier for people to get a mortgage loan. And this is because banks don't have to wait 15 to 30 years to get their investment back. All they need to really do is sell it to Fannie Mae or Freddie Mac, and they can receive their investment back almost immediately. For potential home buyers, the secondary mortgage market can be a bit of a competition or a risk. And this is because investors have a bit of a say in what mortgage rates and fees will be. And this is because, for example, if you have a lower credit score, you're going to have to pay a greater interest rate and fees because you're more at risk to not end up paying all of that loan back. And future possibilities, there wasn't really too much about this in the research, but they did mention that Fannie Mae and Freddie Mac have almost complete control of the secondary mortgage market right now. So perhaps in the future, some competition may arise for them as well. So there are a couple other observations that I made, and one of them was that before 1968, the secondary mortgage market didn't really exist. In the past, only large banks that had enough funds could afford to give out loans to people. And this is because they needed to have enough funds to get them through the 15 to 30 years that the homeowner would be paying back this loan. This meant that the people who wanted to buy a house had a hard time finding a mortgage lender. In addition to this, mortgage lenders had less competition, and that meant that they could charge a higher interest rate as well. Fannie Mae and Freddie Mac came about because of this, and so they're government-sponsored businesses that were created to buy bank mortgages and resell them to other investors. And in order to ensure the security, mortgage loans aren't sold separately, but rather they're bundled together and they're sold. And these bundles are called mortgage-backed securities, and they ensure that the value of these bundled loans are secured. Thanks for watching.